Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest. You ready? Let's dive in.
Today, we are joined by Christopher Johnson, a principal at Knightsbridge Advisors, a firm focused on early stage venture funds and secondaries. For 4 decades, the firm has been helping their LPs access and vet GPs and growth investments. We are thrilled to receive the guidance today from Chris. He is a trusted advisor, having been an economic policy analyst in the Obama administration, an economic and technical consultant with the faculty of Stanford and Carnegie Mellon, and providing GPs and LPs advice at both Constellation Advisors and Knightsbridge. Chris, with such a great background, we're so happy to have you on today.
Thanks for hosting me. I'm happy to be here.
You both advise GPs and LPs. You kind of have this intermediary position, which are both our core audiences. How did you find your way to this world, especially after doing policy work?
Sure. That's a great question. So I'm from Maine originally. So I'm actually talking to you today from Boston, where our offices are. So after undergraduate, I was really looking to do applied finance and public policy work. This was in the W. Bush administration. So I went to work as a policy analyst using essentially econometrics to large-scale data models. It was very interesting. I decided after a few years that I probably wanted to do something a bit more finance-oriented. So I went to graduate school at Carnegie Mellon. That was right around the 08-09 timeframe. So I like to say about 2 weeks after I wrote the biggest tuition check of my life, the economy kind of imploded. So it was an interesting time to be in graduate school. I looked at CMU as a place to both develop more policy, as they have a great master's in policy degree there, as well as an MBA program. So sitting through all of the 08-09 action, I was able to both serve in the White House for the summer in between my graduate school years, and then looked more to applied finance. So it was dealing mainly with litigation matters having to do with the 08-09 blow up, especially around private markets shops. So both hedge funds as well as CLOs, which are a bit more on the rise today, but those were kind of off topic for a while. And then analyzing from a financial damages perspective or a litigation perspective what went wrong. I did that for a few years with a fellow CMU alum, hence why I joined the shop. I moved further doing that type of litigation work, and then also started being a management consultant as well as a diligence consultant to both startup asset managers, so people looking to go beyond, say, 2 people in a Bloomberg, to really build an infrastructure to look at alternative investing, and then also providing outsourced diligence to smaller institutional investments, kind of using the lessons learned both in litigation as well as management consulting. That kind of covers my time, I would say, through Constellation Advisors. All of this was in Manhattan. I moved back here to Boston, to New England, and joined Knightsbridge. So I've been at Knightsbridge now since about 2017, where most of my role is allocating to early stage venture, some growth. But at this point, it's really been kind of a 360-degree journey around private market partnerships. So I've seen how they essentially implode. I've helped build them. And now at Knightsbridge, we allocate actively to them, both on a primary and secondary basis.
Chris, first of all, I can see how your full background helps you in assessing kind of where the future is going, given, first of all, I'm an econ major and I've never said I enjoyed econometrics. So kudos to you on that.
Well, I did for a few years. So
I was introduced and met it and I was like, no. But talk about how just like those prior experiences have shaped your worldview within this asset class.
Sure. So I think venture writ large is a place of ultimate hope, right? Going back to my Obama days, right? That everything has kind of an up and to the right attitude, that you have to really believe in the potential of both the future, but also clearly of your investments to even enter the venture capital asset class. I think my experiences in the earlier part of the century are one of, hey, things can go wrong, right? And as I'm working more and more in venture, that if you think of my earlier finance experience being more hedge fund in all private markets to kind of narrowing down into venture capital, what I'm trying to do is to really take the lessons learned of, yes, things can go very, very right and be very, very good, but we need to think through kind of what potentially could happen if things go wrong, or at least protect ourselves. And me as a fiduciary for my clients to say, okay, how am I risk adjusting my portfolio or my potential fund or even strategy around that? That I think like venture is definitely a place of hope, but I think it also needs to have some caution.
Are there some macroeconomic trends that are influencing your strategy today in venture?
Yeah, so Knightsbridge itself, we're greater than 80% focused on early stage. We do have some growth activity, and then we have a growing secondaries practice, which we've now been at for about 15 years. I think on the early stage side for us, from a macro perspective, everyone talks about exit markets, and for the fund to fund landscape, if you're investing with a Series A manager at this point, if I was able to predict what the exit markets are, say a decade hence, I'd want to probably be much wealthier than I am, and two, I don't know that I'd be doing what I'm doing, right? So I think from a macro perspective, that becomes a little more difficult in that we understand, or we think we understand, where markets are headed, but if we could actually time them, I'm not sure that long-term venture capital is a place to invest. On the nearer term, so looking at secondaries, that's more of a growth equity mindset. So it's more of a 3 to 5 year exit horizon. And what we see there are, because we're often investing in secondaries from of companies that exist somewhere in our fund of funds landscape, we have a much better sense of kind of return trajectory or exit path for those companies. So for us, that's where we're much more paying attention to the exit metrics, the public market multiples, and pure analysis in terms of making an investment. So I would argue that's more bottoms up approach from a portfolio perspective, where Series A is much more top down, blind pool, relying upon the GP and their team and track record.
Maybe it would make sense we can chat about secondaries now, and we can get back to your VC strategy.
Sure.
Could you just share what you're seeing in the secondary market right now in terms of activity?
Sure. So we see bluntly, we see quite a bit of material. So we probably see greater than $2 to $2.5 billion of now a quarter these days, just of opportunity that people are trying to sell LP stakes within venture. And taking a step back, about 3/4 of our secondaries work is buying LPs, and about 1/4 is looking at direct companies. So the efforts put forth on LPs are really for us looking at what the portfolios are and what type of overlap or information do we have based on our fund investing. And I would say kind of, if you think about historically the three types, or at least I think about it in three different types of people or firms looking to sell in the secondary market. Typically have smaller family offices that are probably sub $5 million lots, in that they had maybe an initial $1 million or $2 to $3 million commitment that's now appreciated some or maybe stayed flat. And usually those are smaller family offices looking to allocate a single position. There's a lot of flow there, especially on newer assets. So I think that's kind of an indication that many people got into venture over the last 5-10 years or so and are realizing it's a bit longer asset class than maybe initially anticipated. The second category would be more kind of, I would say, endowments, U.S. endowments style, where you have, say, 5 to 10 to upwards of $30 million portfolios, and whether that's 1 to 5 or so holdings, LP stakes at a time, looking for liquidity. Those are more longer term investors who are typically have been in the asset class for some time. And at the moment, we're not seeing as much in the way of that deal flow. So there aren't that many of that ticket size. And I think that reflects broadly, if you speak to a lot of my colleagues, other allocators in the industry, especially sitting at those mid to larger size endowments, they're not necessarily looking at liquidity from venture. And they actually came out a few years ago, a group of them saying, hey, we'd like to remain in the venture asset class. They're just not actively re-upping at the same pace. So it's not the case that they're selling, they're just not making new commitments. And then on the far end of the spectrum are kind of those greater than $50 million lots that are typically asset managers or other fund of funds potentially winding down, just larger ticket sizes that are looking more either to sell an entire private markets portfolio or an entire venture portfolio for any number of reasons. It could be a fund wind down where the prior management team is looking to crystallize carry, or the prior LP base is looking to crystallize some sort of DPI. And in that case, you have kind of all over the map in the sense of what we like to do at Knightsbridge is look at smaller lots, potentially more off the run or niche strategies. So we would look at, a much larger portfolio like that and potentially a smaller allocation to ourselves, and then maybe syndicate with a partner. But I think the whole at the moment are kind of where you're not seeing as much deal flow as that middle ground. And then I'm sure you both have read significantly about continuation vehicles. So those have been on the rise, I would say, over the last year and a half or so, that managers are looking to kind of consolidate their winners, push that forward, but then also distribute some sort of monies back to their initial LPs. So those offerings are increasing in nature. We've participated in a few, but we're not heavy participants in GP continuation vehicles. But that's definitely a growing area of the marketplace. And then on the direct side, it's a little different game in that there are more and more platforms coming to market, like Hive or Forge, that I'm sure you all have seen. Our Carta had made a play at that as well. And then I think most recently, Morgan Stanley announced that they were looking to build a private shares platform, as well as Fidelity, actually, I read about this morning. So there are a lot of different places that startups are potentially looking for liquidity. And I think while those markets are clearly not fully efficient, they're becoming more and more efficient. So bid-ask spreads are narrowing compared to LP transfers. And so for that reason, it's a smaller part of our practice, but you're seeing much more flow on that side. So there are ever greater number of private market shares out there, especially for late stage companies.
I'm kind of curious what it's like working with those platforms. It's like if you've been doing this for 15 years and now a platform's coming to you asking you to participate.
Sure. So the platform itself is, I would say those on the LP side of the business are pretty rudimentary. And on the direct side of the business, they're easy. I mean, the interface, while not E-Trade, for instance, it is becoming easier to look at what potential asks are out there. However, most of these markets don't actually show you completed transactions. So you can see the asks, and you have an understanding, like Knightsbridge would have an understanding of what we'd like to pay for a lot, but we're often not seeing, well, what are these prior transactions actually being transacted at? So I think it's a bit of a one-sided market in that sense. But the data itself, similar to LP and even similar to primary fund investing, that data is extremely limited at venture. So while yes, there may be shares of XYZ company on this platform, you don't really have an understanding of where do those shares stack up, like common shares or common shares, right? But how many common shares are there? Or if it's a preferred share, what does the waterfall look like? So it's really beholden on a firm like ours to go do the research and understand the capital stack before we try to anticipate purchasing an asset. So I think the interactivity is good. I think, if you're a qualified investor to step onto those platforms and you know what you're doing, it's a benefit. But I think the transparency is still lacking in the underlying. It'd be very similar to, say, buying a preferred share on E-Trade, right? That like you could be buying something, but you don't necessarily know what the financials of, say, an IBM are, or why this share is preferred versus common. And it's really beholden on you to go do that research.
Your LPs, Chris, can look a lot of different ways, whether they're individuals, family offices, foundations, endowments, insurance companies, pension funds. What are you hearing from current and prospective new LPs of what they're looking for in the market, especially the early stage and growth?
Yeah, so I think the very first question I got, is often our newer LPs are LPs who haven't invested in venture, and they understand kind of the benefits of a fund-to-fund approach to primary investing, potentially, a diversified, well-balanced exposure to venture and hard to access premier managers, right? That's essentially our elevator pitch. So if it's that type of LP saying, hey, I'd like to have access to the venture asset class, how best do I do that? I think it's a relatively straightforward conversation. If it's a returning LP or an LP who's been in venture before and may or may not have had a great experience, maybe in a prior business cycle, or if it's a family office that was at one point in, then decided to get out and now is looking to get back into venture and maybe missed the prior cycle and is kind of regretting that. Maybe not the immediate prior cycle, but the one before, so the late teen profile. They had missed the live distributions there and are saying, hey, maybe now's the time to dip our toe back in the water. The biggest concern for those who have been in the marketplace before is valuation, right? So if you're looking at kind of where marks are, where firms are investing, is it really a Series A investment if you're putting X number of dollars at Y valuation? So a lot of kind of discussion I have, especially with professional money managers, is what type of entry are we getting? And then from there, what's the type of return profile we can expect? And for us, it's really looking forward to relying upon GPs who have done this before, who have had a team through multiple market cycles, and who are properly managing their early stage portfolio for the next 3 to 5 years over that allocation period to get a path to exits that would line up with our past performance. The other big question is just why venture? Yeah. That's more of a beginner's question. So if you're coming to me and a lot of what I like to think I do at Knightsbridge too is be a cheerleader for the venture asset class. So thinking through, in my mind, if you're looking to capture the portion of either the US or global GDP that's growing, you're looking mainly at venture-backed companies, right? I think private assets, especially those backed by venture firms, typically in the case of Knightsbridge, mostly tech, but some life sciences, are where really true value is created. I think if you're more worried about, say, financial engineering or rearranging deck chairs on a large ship, venture probably isn't for you. But if you are kind of that belief, as I was talking about before, where there is a better tomorrow, I think venture capital speaks much better to the investor class than, say, an LBO transaction where you're investing in a widget company that may or may not have high margins and a market you may or may not understand.
It might be interesting. A lot of our, if you're an emerging manager, you haven't dealt with higher up the stack LPs and endowments and insurance funds and pension funds, but these are the LPs you work with daily. So anything you can share with what it's like working with some of these larger institutional LPs?
Sure. So I think the thing I like to stress with newer GPs, and as an aside, I am a part of the Kaufman Fellows program, which deals a lot with newer managers. Really, there are two dichotomies. On the family office side, the famous saying is, if you've met one family office, you've met one family office, right?
Absolutely.
So a lot of those LPs have very differing either views or needs of venture capital. And it's very important to understand who is sitting across the table from you before either you approach them as a prospect or you continue in your investor relations with them as an LP. On the larger side, I think, it becomes much more about client service. So as you think about a large insurance company, typically the person on the other side of the table from you is a salaried employee who may or may not be compensated on the performance of their portfolio, but at the end of the day have a reporting line somewhere. And what you're looking for as a GP, or what I'm looking for as a GP, is a champion within that organization that really believes in either me or my firm. Mm-hmm. And so the thought process there is, how can I best deliver and assist this person in what they do for a living? And if that person is looking to build a venture portfolio or looking to build up, say, in the case of a large insurance provider, if they're looking to build a strong alternative markets, they have a fixed allocation amongst their investment pool, and they need really, a Knightsbridge size puzzle piece to fill out their venture asset class. How can I best reflect venture as being a strong part of their portfolio? From a risk adjustment perspective, again, going back to Knightsbridge's history, we're 41 years old. So where I'd like to say we have kind of the most conservative LPs in a non-conservative asset class. So what we're trying to do is risk adjust our approach into a way that makes sense for LPs like the ones I was talking about. And again, it's really more of a relationship based both with the person and the firm. So thinking through kind of you and your team, what are you looking for when you're investing in venture, and how can we best serve that?
Thinking of yourself in client services, I think, is a huge jump for some of these folks who consider themselves, sourcers of great startups.
Yeah, for sure. Yeah. And I think like my participation in Kaufman, and then also just as an aside, sitting in a fund to fund, I meet with managers, probably average about one a day, that, the important aspect of all of this is someone sitting where I sit, or even someone sitting in an insurance company sits, or an endowment. All of us are serving a client at the end of the day. Yeah. And in my case, I actually have to go actively raise funds, right, to invest a fund to fund. In an endowment case, it's a little different. They're not probably as participatory in the fundraising aspect, but they still have reporting lines, right? And at the end of the day, they have clients. And what I try to do in Kaufman, and what I often try to do when I speak with emerging managers, is that in today's environment, money is not easy to come by in any aspect, right? Yeah. And so thinking through kind of how does that person's life made better by investing in a firm like mine, or how is on the flip side, how is a GP's life made better by me making allocation is important. So I think these GPs, generally on the emerging side, need to think through that, as my grandma used to say, money doesn't grow on trees, right? So thinking through that, a dollar means something quite different to different parties, and understanding what that means is really, really important on fundraising.
Chris, how do you just even tactically, all of your LPs are coming from different perspectives that you might have longer relationships with others. How do you make sure with all those puzzle pieces, you provide the right kind of output for them, right? Is it everybody just get the same product, or some want, slightly different products? How do you make sure you're providing everything to everyone?
Yeah, that's a great question. So structurally, Knightsbridge sits on like what I think is a three-legged stool, right? So our 41 years is mainly venture capital fund of funds, and we still do that. For the last 15 years or so, we've been raising secondary funds, which is typically a different client base, just because of that shorter duration or shorter term, as well as a different return profile. And then the third, and kind of not as mentioned, part of our business and part of the industry, are what we call separately managed accounts, or SMAs. And those are typically funds of one or funds of few, right? That a client will come to you and say, I have 10, or I have 50, or I have $400 million that I'd like to allocate to venture. I'd like you to manage that, Knightsbridge, and whether, and then we can talk as to whether or not it's discretionary or non-discretionary account. So thinking through kind of how I can best serve each of those three buckets is different. While we have clients who are participating in all three buckets, or all three legs of Knightsbridge, we have others that are just solely focused on secondaries. We have others that are solely focused on SMAs, where they have a customized portfolio due to either their focus, their sector, their interests. And then we have fund to fund clients who have come back to us for, approaching half a dozen funds now, that really what they're looking for us to do is provide an outsourced venture exposure for them. And then, similar to many endowments, what we try to do is allocate in such a way that inevitably future capital calls are met by present distributions, right? So by, say, the third fund cycle, often the distributions being made by your first investment are meeting the capital calls of your third. And at that point, you kind of maintain a relatively steady state exposure on a cost basis to the venture capital asset class. Also, a lot of phone calls and coffees.
So. I was going to say a lot of phone calls and coffee. And it's great if it perfectly works out that way with the third fund. For fund managers who are trying to get to know you, now understanding kind of the entire backdrop of what your day-to-day is, Chris, what advice do you have for them on talking to an organization like yours?
Yeah, I would say, bigger picture, organizations like mine, and there are a number of fund of funds or intermediaries, or other, say, high net worth channels on a lot of the major banks, usually those conversations are relatively slow. So, right, if you think about venture as a relatively fast moving asset class from a deal perspective, it's a very slow moving asset class from an LP allocation perspective. So while I have had first meetings with managers who were expecting a check after that first 45 minutes, it is very, very, call it extremely rare to get that allocation in a manner like that. In fact, I don't know that it's happened in my time at Knightsbridge. So for us, doing what we do on the fund-to-fund side of the business, we typically maintain a pretty robust roadmap over the next 3 to 4 years. So I have an idea of where not all of my assets, but a good number of my assets are going based on past pacing of my underlying GPs, as well as other GPs that I'm keeping an eye on. So getting into that roadmap or on that radar is probably the most important first step. But the expectation and the understanding that, an allocation might not be forthcoming for this fundraise, may not even come for the next one, but that if you're, constantly reaching out, we have good back and forth, that's potentially a target down the road. So the expectation setting on, say, an early, like a fund 1 or a fund 2 manager is really important. Because, at the end of the day, venture is an asset class of very successful people. People who have been typically successful either in investing, have a great track record, or very successful operators who now think they can be VCs. And in both of those cases, there's, the failure rate of someone saying to their face that essentially I'm not giving you money, and which they're translating, which may or may not be true, as I'm not good enough, is a hard message to take. So it's preparing yourself mentally to say, okay, maybe not this time, but maybe next time, and that's okay. And what that also translates into a lot more meetings than I think than are expected from an early first-time manager. So it is the case that you're probably going to get triple-digit number of meetings to raise a small to moderate-sized fund. And it's not typically the case that like your first 5 meetings are going to be 10 million each, and then you're walking out the door with a $50 million fund.
Now we're going to take a quick break to speak with our sponsor.
Next up, we have our industry expert and sponsor, Dave Thornton, co-founder, CEO, and chief investment officer of Vested. Vested provides funding to exercise your stock options. Thank you so much, Dave, for joining us. You also have a partnership with Carta.
Yeah.
How's that work?
So we are an API partner of Carta's. For folks who are not aware, Carta is the preeminent cap table provider, and they do a bunch of other things in the private markets. I think they've got something close to 80% of VC-backed startups that use them to manage their cap table, and maybe half of them use them for 409A valuations, and they've got a fund administration business. So they've got their tentacles in a lot of places. They opened up an API to select partners in the last year, and we are users of their portfolio API, which basically means you're a Carta user. In other words, you're an employee who has your stock options administered by Carta because your company is paying Carta to do that. You can come to vested.co, and before, if you were to tell us about your stock options, you might have had to manually enter them into the website, and you might have had to cognize the difference between an incentive stock option and a non-qualified stock option, and you might have fat-fingered a couple of your details and gotten it wrong, and you might have gotten your FMV wrong. Now you have the option to link your Carta, and all the data that you otherwise would have taken 10 minutes to type in, or 5 minutes, but still an annoying amount of time to type in and might have gotten wrong, will kind of stream directly from the source. And that has been a pretty significant de-frictionization of our user experience. So it's been great working with Carta on that.
Yeah, for sure. And as you said, things like fair market value, they're being updated annually, where they ought to be.
The fair market value is a funny one. It's because it is a capitalized term. It has a defined meaning. It is produced by a third party. It is approved by the board. But when you just say to somebody, what's the fair market value of your stock? They take it, I'd say it's a third in the following buckets. 1/3 is they actually know what it is and they provide the right number. The middle third is they think it's whatever price the company most recently raised its round at, which is not unrelated, but not even close, because that tends to be preferred stock that's issued to new investors, and preferred stock and common stock are different things with different values. And then the last third is they take it as an invitation to just say what they think is fair. So it is really, really nice to have the opportunity to most of the time stream it from the source of truth. It makes for a lot less follow up from us to the employee that asking for a correction.
Yeah. Well, we giggle, but I guess in some of these, marketplaces and so on, the price is what somebody will pay for it. So, what is fair is fair. It's nice that you're actually not having to negotiate any real numbers, that you're working with things that are already predetermined.
Yeah, it's great. And operationally speaking, we don't get the opportunity to meet 30,000 management teams. And so the traditional primary venture capital approach of, doing a full forensic evaluation of a company is not on the table if you're going to run our business model. So we have to use the prices that already exist.
Yep. The same number the tax man uses. Any parting words for LPs?
Only that if you're interested in thinking about high quality index style exposure to venture, so think of this as smart beta. We are now about to start launching a bunch of these products in earnest, and we are very, very open to feedback. We can programmatically put a lot of capital to work helping out the employee base that I just described, and it's an interesting time to kind of be one of our early LP partners in the new business model.
Thank you so much, Dave. To start working with Vested, you can please email investors@vested.co and mention this podcast. And now back to our LP interview.
Chris, have you ever received deal flow from the outside of the fund-to-fund kind of funnel and from more the kind of like special purpose, or I forgot the exact term, but like one of your dedicated funds from one of your LPs?
From the SMAs?
SMAs,
yeah, for sure. So yes, I think people approach Knightsbridge thinking the fund-to-fund is our only strategy, or people, and by people I mean venture managers, newer venture managers, thinking that it's either fund-to-fund or bust. And for us, while I appreciate cold emails, warm intros are way, way easier. So getting a nice introduction from either a current LP of mine or a current VC of mine is quite a bit better than trying to just cold email me, because my spam filter cannot keep up with the number of emails that come in every day, and I just hesitate to say it's hard. It would be very hard for me to reply to everything. And actually, as an aside, I had a dinner with a group of fellow LPs a few months back, and one that was the head of a very large family office was saying, if I took the time at the end of the day to say, to write, even one sentence response to all the inbounds like that, that's really time away from my personal life. And at the end of the day, is it really that constructive? So the thought process around cold emails is difficult for someone sitting in my seat just because of all the inbounds I get. So warm intros are much better, I would say, just generally, versus just trying to send me an email and then replying to that email like 5 times, which is the case. I have one that I just keep notes on because I think it's the double digits now, where I'm just like, okay, like I don't know what to do with this anymore. This is getting a little weird.
Have some empathy, people. Chris is busy. He's a lot of people want to meet with him.
Or make it about your life too. Catch up. See how his kids are doing. I don't know.
Yeah, exactly. Find another way in.
Is there anyone you're actually looking for right now? If this was a push versus a pull opportunity.
I'd love to speak with people, and this is more thought process than like I need someone in this sector, but I'd love to speak with managers who are thinking beyond the current Gen AI craze and thinking about what potentially the next step is. And this is like more armchair economist than anything, but it seems like so many dollars are flowing to infrastructure, which may or may not be a good thing from an early stage perspective. But thinking through kind of what comes next, I think is not as well defined. And if you think about kind of the way I think about it is more of a cloud infrastructure framework where you have, the notable big winners, right? The Googles, the Amazons, the Microsoft of the world are also appearing to be the notable big winners of AI infrastructure. But if you look at kind of all the companies that were built upon cloud infrastructure, there's a lot of value creation there, right? And you can look on Knightsbridge's website to see some of the firms we've had exposure to. I'm wondering what kind of the next generation of firms that, represent kind of the Cloudflares or the Snowflakes of the world, what will those look like in AI?
Mhm.
And any thoughts there could be potentially interesting.
Awesome.
Yeah, that makes a ton of sense, and that's kind of our job to be thinking about what's next.
Yeah.
What's a complete, like, I always like to ask his allocators, a complete no other than emailing you 15 times straight without a response. What's a complete no when first meeting with an allocator or yourself, Chris?
So one of my favorite stories of all time is, so I started at Knights. So as I mentioned before, I started my career in hedge funds in Manhattan, private equity, relatively sharp elbowed, right? I was wearing a suit and tie every day. Different lifestyle than venture. And like right around the first year of work at Knightsbridge, as I mentioned, and this was back when we were in office more often. So we were in an office. I had a brand new analyst with me who was less than a month into the job, and we took a meeting with a person who was passing through Boston. Because of where we sit, a lot of managers come to the Boston area to speak with the endowments, and while they're here, they often meet with us. So I'll often kind of leave and open a couple hours in the afternoon, just saying, every week, saying if someone stops in, that's fine. They can stop by our offices too. Anyway, great meeting, decent, probably not a fit for us. I gave the preamble about why it's probably not a fit for us before the meeting even started, right? It's a pretty high hurdle. But would still love to hear the pitch if you'd like to, give that to us. And at the end of the meeting, the guy goes, "What is $5 million to you?" And I'm like, "What?" And he kind of stayed on that line of reasoning for about 2 or 3 minutes, and it was just really, really awkward. And it was like, okay, all right, great, good meeting, thank you. And he leaves our offices. My analyst is like, "Are they all like this? Is this how it works?" He's like, this might not be great. And I'm like, no, that's typically not how it works.
Wow.
So I appreciate the ask, but if the ask is like immediate, and you're not getting the positive vibes from my side of the table, it's probably not happening. So that would be a big no. I would say number one. That was really awkward. I think the other big no for me is going back to kind of the cold emails. Is I'm often the point person on a lot of databases like PitchBook and Preqin and others like that. Please look at your audience before you send emails. Kind of you can figure out what Knightsbridge does based on our website or any kind of generic elevator pitch like you gave at the beginning. But I still get kind of like cannabis farm pitches, oil and gas pitches, a multifamily apartment building pitches. And the flavor of the moment is private credit, which we really don't do. But all the same, these are like taking up seconds now of my day in my inbox, just thinking through. So the big no for me is not doing the research before you step into the meeting and not understanding how a fund to fund may be different than an endowment or a family office. So just thinking through kind of what the different flavors of LPs are really, really important.
But also a benefit or insight is now any allocators out there who do a lot of different things in privates. Hey, if you're looking for multifamily deal flow, Chris can help you out.
Right. I'll just keep forwarding it. Just send me an email to forward it to. You want to buy like a multifamily? I don't know why I get these emails. Like I've unsubscribed so many times. I'm just like, yeah, no, I'm good.
We recently launched Fourth Stool at Knightsbridge.
Yeah, exactly. Yeah.
Fourth.
Yeah. I got oil futures trading down in the basement. Don't worry about it.
That's hilarious.
Is there a piece of advice you've received in your career that's been meaningful?
I think the big thing for me is, time is valuable. You don't get that back. Yeah. And on the flip side, venture is a very long asset class. So the relationships you make in this business are typically very long lived, and it's very much a repeated game. That on the LP side and the allocator side, my network's pretty broad. We all talk. We often switch chairs. So there'll be, people move from an endowment to an endowment or an RIA to an endowment or vice versa. And once you kind of have a toe in the venture ecosystem as an LP, you're typically have an affinity towards it for quite some time. So I think both spending time with venture managers is important, but also understanding that it's a very long time horizon within venture, and that, memories are long both on the GP and LP side. So you see a lot of the same faces. And if venture cycle, if fundraising cycles are ideally about 3 years apart, hopefully, can we get back to that? But that means like if you've raised 3 funds, you're in it for a decade, right? And often you're approaching the same people over 10 years. So I think that's really important to know that, it's first impressions matter, but it's also length and depth of relationships are quite important too.
No, I actually think that's been one of the biggest pieces of feedback we've gotten for doing this podcast. Thank you for coming on. That now Knightsbridge and you are real entities. You're not just this. You're not a name or an email in a database where people, I don't think, necessarily feel like they see the human behind the easy $5 million.
Yeah, I know.
Just
What's
an
it to you?
easy. Yeah. What is it?
What's it to you? It's like,
why are you being stingy?
On the flip side too, like is on the in the secondaries, part of my day job, like one reason we're able to purchase LP interests is often there's turnover too, right? So I read something like the average CIO in an endowment is like 6 years. And if you think about like a primary fund that is not unheard of to go, 15 plus, that's like 3 people, right? It's a parent and then 2 step parents of a single fund. And ideally, if the GP is still there, you're maintaining relationships across that spectrum. So that was a bit eye-opening for me as we were diving deeper into secondaries world, and as the flow is picked up there, that you're really seeing assets being sold that, the person who made the investment decision, and often even the documentation around that investment decision, aren't available 12 years later, right?
That actually brings up kind of a question for me. We're seeing kind of like the movement on seats, both from GPs and LPs. Quick aside, one friend told me that a question that founders are asking, kind of like late 30s, early 40s GPs, is like, are you a flight risk? So like there's just like there's like a fear there. But I didn't think about it from the allocator side. I don't know if that trend is accelerating more and people are changing seats more. So I would love to know that. But then
I would say that's a great question. I don't have any numbers. I think conceptually it was easier to change seats in a zero interest rate environment, right? Where people weren't paying attention as much to DPI. They were really just looking at markups. And could you have an interesting, say, sub 5-year track record and then go hang your own shingle and raise, say, 10, 20, $50 million? I think that has become extremely difficult. But on the flip side, we've invested with any number of managers that have gone through either a single or multiple generational transitions. And I would say beyond values, which is a minority of the decision-making process, it's almost always economics. And the question in my mind, and a lot of our diligence, is looking at both the leadership of a GP that we're making an allocation to, but also who's coming next, and what that potentially looks like in the future. As a fund to fund, and I think this is true of many allocators, that yes, we're making an investment decision on a single fund, but part of our analysis is, is this a potential for a second or a third fund allocation as well? So if, your entire team makeup is transitioning from one fund to the next, it's not typically an investment for Knightsbridge, because we're also, investing in you as a firm, you as a person, but also you as a firm, right? So we want to see that we've had this multiple times because we invest in spin-outs. We often look at the prior shop. And if we're re-upping with the firm that the person departed from, we want to see who's remaining and what those individual contributors look like, as well as what the new contributor is doing, say, on the spin-out opportunity. So it's definitely something we think about from a, we don't necessarily call it a flight risk, but we say, what is your strength to the team, and are you being, at first principles, are you being well compensated? And if you're not, or it's not as prevalent today because of Zoom, but back when there were in-person meetings, it was very obvious who was driving the conversation. Like I've sat in GP meetings where, say, a principal will be introduced at the beginning of the meeting, and then that person will say 0 words for the next hour. And you get an idea of, okay, like I'm glad I got to meet the new principal. I don't know that I remember that person's name, but I can see who's, driving the bus here. And then on the flip side, going back to kind of that repeated game, if I know, what your your attribution looked like from a performance perspective on this fund, I may have said no. On the next fund, you have different personnel and you're sending me an attribution file. I would highly recommend it. Looks very similar to the previous one. And there's been more than one occasion where it's not. So for someone sitting through a repeated game, you kind of understand what's going on, right? That like, oh no, I actually sourced that deal.
Really? You're saying I can't put all the bad deals on the person who just left?
I wouldn't suggest it. I mean, unless it's all new prospects, then no worry. But just if you've called me before, yeah, probably not. You might want to check out your Excel file before you send it.
This has been so fun, Chris. Any final thoughts for this audience?
Yeah, I mean, I think, tough times will get better. I think, people see fundraising as difficult right now. I think it may have swung too far the other way in the prior environment. It shouldn't be easy, but it won't be impossible. And if your difference is valid and your track record is strong, someone will allocate to you eventually. May not be me, but there's enough capital out there looking for interesting ideas and venture that, it's not the end of the day. The other thing I would say too is discover what your MVP is for your fund size. So yes, you may be trying to raise 200 million, but is it a strategy you can deploy at 100, at 75? At a certain point, it may make sense for you to try to go to the market and start building a track record than to remain, fundraising ad nauseum. And there's that's a decision I don't have a specific answer to, but thinking about trying to get in the market and show your abilities on the investing side as soon as possible would weigh on me as an early stage, allocator, and should weigh on you as an early stage investor. If you're able to find those deals, go to it sooner rather than later.
Well, Chris, thanks so much for spending time with us and sharing all the knowledge and great anecdotes as well. If you're, I was going to say, if you're interested in talking to Chris, I'm sure those people know how to get to you anyway. So
no, you should email Ernest. You should email Ernest first and then let him be the filter.
Yes. Let me be the filter. I'll take all the oil and gas and real estate. Yeah. But seriously, thanks, Chris, for being on.
You're very welcome. I'll speak to you guys soon.
See you later, allocator.
After Portfolio Tile, investing with a smile.